Get this, other than the government, King Charles, the monarch, is the largest individual landowner in Britain, worth over £20 billion, owning over 700,000 acres of land, over half of Britain's shoreline and virtually all of the seabed. But it doesn't end there. The monarch owns 6 of the 10 most expensive homes in the UK, but it also stretches to properties like business parks, small rented cottages, and properties like the Tower of London that alone is estimated to be worth about £880 million. But it's not just the monarch that has understood the long-term value and influence of owning vast amounts of land and property. 77% of people earning over £500,000 a year said they were looking to increase their UK property investments in a recent survey from Investec Bank. As a result, Investec themselves have launched a UK real estate equity investment strategy with the aim of raising £250 million to buy up property in the next 2 years. And they're not the only ones. Over £4.5 billion of investment went into the build-to-rent sector last year, mostly from big private equity firms, and year after year has been hitting bigger and bigger highs, breaking bigger and bigger records. So what the hell's going on here? On one hand, we've constantly hearing in the press that the buy-to-let market is dead, that landlords are escaping the sector, but beneath the surface, the tectonic plates are moving differently. The mega wealthy and enormous private equity firms are literally pumping billions into gaining UK property market share. Let's talk about why the rich are targeting UK property, but importantly, how are the rich targeting UK property so that you and I can do the same? Why are the rich targeting UK property? To kick off, exchange rates. As the pound has got weaker against the dollar over time, not only does it make what we then buy from pounds to dollars more expensive, but it has the complete opposite effect for those spending dollars to buy assets in pounds. The dollar stretches further against what you spend in pounds, which encourages a hell of a lot more investment. And the thing is, it's not just the dollar that the pound is weakened against, but also the euro. As a result, this creates a huge incentive for foreign capital to invest in British assets like property, as ultimately the pound weakening makes their money stretch even further on assets like property. Another core reason the rich target property is due to how unpredictable the future is at the moment. The war in Ukraine, high interest rates, unknown future tax changes makes not just you and I nervous about the future, but everyone that looks to invest money. As a result, the wealthy tend to then focus on stable, low-risk investments in assets like property. But before you think, wait a minute, property investing is no longer a good investment, despite the headlines, UK property does still produce predictable returns compared to competing assets. For instance, on average, London rental yields still outperform most of Europe. And when you tie in the rest of the UK, the average rental yield stands at just over 7%. And we're not even taking or talking about the fact that house prices have always generally risen over time. So it is this balance between investors being able to achieve a reliable yield as well as that a capital appreciation over time that makes property just so attractive to investors right now. But finally, the thing that's putting off day-to-day landlords now is exactly what's making the property market more attractive to the wealthy, and that is the higher barriers to entry right now. Things like the 3% extra stamp duty, Section 24, the tenant fee ban, high interest rates, and now Labour's Renters' Rights Bill are all things that make operating as a landlord more difficult and more capital intensive. And as a result, it is reducing the supply of buy-to-let properties exactly at the moment the demand for rental properties is at an all-time high. And although rental yield increases are slowing, they are significantly higher than they were in the past. Think about all this for a moment. What a massive opportunity this is creating for the wealthy investor or the big corporate investor. Competitors are being driven out the market, and yields on buy-to-let property are increasing faster than they have for decades. So why are landlords exiting the market? Well, the returns on debt has been driven down by higher interest rates, but the ultimate yield and capital appreciation on each pound of property is still very competitive when you compare it to other investments. So how are the rich targeting UK property? It's an economies of scale game at this point. Historically, the UK property market has been dominated by a patchwork of smaller buy-to-let landlords, whereas in the US and in continental Europe, much of the buy-to-let market is dominated by specialist corporate landlords that don't own a handful of properties, but literally own and manage thousands, if not tens of thousands of properties. As a result, the UK property market has been targeted as an opportunity for big companies and private equity firms to modernize the buy-to-let property market. And as a result, literally billions is pouring into UK property from not just the likes of UK companies like Lloyds Bank and John Lewis wanting in on the action, but US investing giants like Goldman Sachs. And the main way they are capitalizing on economies of scale is not necessarily buying up lots of individual buy-to-let properties around the UK, but to build to rent. Why buy up hundreds of buy-to-let apartments if you can simply build a block of hundreds of buy-to-let apartments? And it is this logic that is fueling this surge in build-to-rent investments at the moment. And the economies of scale that brings doesn't just stop there. Things like the management of maintaining properties and managing tenants can be centralized, making it more efficient, and thousands of properties being managed by one landlord rather than thousands of properties being managed by thousands of landlords, of course, again, can be more efficient. The logic is these economies of scale cut costs, increasing the return for the larger investors. But in theory, the setup also provides tenants a better experience, as rather than dealing with an evil landlord, you're dealing with a company providing a professionalized renting experience, whatever that means. Ultimately, you and I know this consolidation of smaller landlords being replaced with bigger corporate landlords is the exact same sort of thing we've seen across industries for decades now. The high street isn't full of independent shops, cafes, restaurants. No, it's full of corporate chains. It is this same consolidation process the mega bucks of industry are looking to take advantage of in the buy-to-let sector here in the UK. So how can you do the same? How can we do the same? The best way to seize the opportunity in property investment is to play a different game to the big corporates. Corporate landlords will target buying blocks of flats, building massive developments. Instead, focus on buying up day-to-day properties within local communities people want to live. Corporate landlords will offer corporate service and vanilla properties to rent. Instead, focus on providing niche, trendy buy-to-let properties and offer a personalised service. And of course, exactly as the corporate landlords will do, focus on building a portfolio of quality buy-to-let properties in fast-growing buy-to-let areas with strong rental yields. Just look at the yield difference between London and Leeds, for example. I'd love it if you comment what you think of this video. What have I missed? And like and subscribe if you want to see more of me. And I'll see you in the next video up here.